Hey everybody, John Bowens here with Equity Trust Company, and we're broadcasting live today from the Equity Trust Company corporate headquarters right outside of Cleveland, Ohio in Westlake. It's a really exciting day today. We are remembering the late William Roth Jr. He was a senator from Delaware. Now you're probably thinking to yourself, what's the significance of Monday, July 22nd and William Roth Jr.? Well, we're remembering William Roth Jr. here at Equity Trust Company because of his accomplishments as the legislative sponsor of the Roth IRA. So today's session is going to talk all about the Roth IRA and how powerful this tax advantage tool can be for you as an investor. So let's get right into it. Now, what we have broken out for you here today is 3 key characteristics. Now, there's a lot of aspects of the Roth IRA to talk about, but I want to break this down into 3 very powerful and important characteristics. The first one is understanding compounding interest in the absence of taxation. And you're going to see a compounding interest example in just a moment, and you're going to understand why this is so compelling. Number 2, I want to talk about specifically the self-directed Roth IRA. Because see, you could have a Roth IRA with just about any financial institution, and many other financial institutions are only going to limit you by investing in certain types of asset classes, typically stocks, bonds, and mutual funds. But with a truly self-directed Roth IRA, and if you're working with the right financial institution, Equity Trust would be that type of institution that can allow you to invest in a wide array of assets, not just limited to stocks, bonds, and mutual funds. So we'll talk about real estate, notes, and other types of alternative investments. Last but not least, we'll talk about converting funds from a tax-deferred account into a Roth account. Or for those of you that have been told that you don't qualify for a Roth IRA because you make too much money, we'll talk about how you could potentially still qualify for a Roth IRA and transition funds from a traditional account into a Roth account. So again, we're really excited here at the Equity Trust Company corporate headquarters in remembering the late William Roth Jr., who was a legislative sponsor. In fact, I heard that he made multiple attempts in presenting the legislation to Congress before it was actually passed into effect. And that was back in 1997, 1998-ish. So IRAs and retirement plans as we see today go way back to the 1970s, but the Roth IRA didn't come into effect until 1997, 1998. Now, important to understand the fundamental difference between a traditional IRA and a Roth IRA. And even take a step back even further, let's talk about the 3 buckets that you need to understand. Bucket A would be your taxable account, your taxable monies. So think about it. You have money in a savings account, a checking account. You go out and make an investment. Maybe you buy a property and sell it, or make a loan and you have interest income coming back in, or you buy a stock and you sell that stock for a capital gain. And all of that income is taxable because it's in your taxable environment, all right? It's not sheltered. Now we move over to a traditional IRA or tax-deductible account. And there are other accounts that would fall into this category too, like a lot of 401ks, 403bs, thrift savings plans, other employer-sponsored or government-sponsored plans are typically tax-deductible accounts. And what those tax-deductible accounts mean is that when you put money into the account, you get a tax deduction, it grows tax-deferred, and then when you take money out after the qualified retirement age of 59 and a half, you have to pay taxes. So the analogy we use in the industry is you didn't pay taxes on the seed, so you got to pay taxes on the crop, all right? And you're going to see that in just a minute in the compounding interest in the absence of taxation example. Now we move on to our 3rd bucket, which is the bucket that we're focusing on today's live session, and that is the Roth bucket, the tax-free bucket. So with the tax-free bucket, we put money in after tax, get the taxes out of the way on the seed, and then we don't have to pay taxes on any of the growth, and we don't have to pay taxes on any of our withdrawals. So as long as we're following all of the rules associated with these accounts. So think about it. As a real estate investor or someone even just investing in stocks, bonds, and mutual funds, all of your growth tax-free, all of your distributions after 59 and a half, 100% tax-free. So let's get to the whiteboard over here, our compounding interest example. So what I did for demonstration purposes here, so you can understand this concept of compounding interest in the absence of taxation, is give you a very simple, concrete example of starting with $6,000, making a contribution every year for 25 years. All right? So we're putting $6,000 in year one, and then for 25 years we're going to grow that $6,000, and then every year we're going to make an additional $6,000 contribution. So why did I pick $6,000? Well, there are contribution limits. The amount of money you take out of pocket and put into a Roth IRA, when you're under the age of 50, you can put up to $6,000. Earnings potential is unlimited, but the money you take out of pocket and put into the Roth IRA is $6,000. When you're 50 and over, by the way, there's a catch-up provision. You could put up to $7,000 in the Roth IRA. Again, that's irrespective of earnings, rollovers, and transfers. So $6,000 in every year over 25 years. I'm going to plug this into my financial calculator. And oh, by the way, if you're interested in running some of these numbers on your own, if you go to the Equity Trust website, trustetc.com, and you go to our calculator section, we have all of these calculators for you. So you can actually plug and play these numbers on your own as well. So I have $6,000 every year going in for 25 years. I'm going to apply a 12% return on investment, 12% ROI, compounding just once per year over these 25 years. And for the purposes of this compounding interest example, I'm going to apply a 30% tax rate during the income years. So while I'm growing this money over the 25 years, I'm applying a 30% tax rate, and then I'm applying a 20% tax rate. So why am I doing this for this hypothetical scenario? Well, my assumption that I'm making is that I'm going to have a higher tax rate during my income years, and when I retire, I'm going to hopefully be at a little bit lower tax bracket. All right? So 30% and 20%. Oh, by the way, let's break that $6,000 down to per day. That's only $16 per day. So this is the latte or cup of coffee or extra food at lunch, right, concept, right? Take that money and otherwise put it into a Roth IRA every single day, $16 per day. All right? So if I take this example, all right, and I apply it to a totally taxable environment, over 25 years, my total profit and all of the money that I accumulated is $601,000. So I'm talking about that taxable environment again, guys, okay? The taxable environment. Now, let me take this same example and I apply it to a traditional IRA or tax-deductible environment. Again, that's where when we put money in, we get a deduction, we get tax-deferred growth, but when we take the money out, we got to pay taxes. If we took all the money out after the 25 years, all the money out in 1 year, we will only have $894,000. Now we apply all of these numbers to a Roth IRA environment. So here's our Roth IRA environment, $1.1 million. All right? So what we've effectively done using this example, 12% year over year for 25 years, we take all the money out year one, we will have saved $223,000 compared to the traditional IRA. And you can do the math comparatively to a taxable environment, which is over $400,000 in taxes saved. So as you can see here, compounding interest in the absence of taxation is an incredibly powerful concept. All right? Now, you're probably saying to yourself, wait a second, John. This doesn't make sense because most people aren't going to take all of their money out year one in their retirement. So take our avatar here, growing this $6,000 every year thereafter, $6,000 contribution for 25 years, they're likely going to take money out during their retirement years over many years. And that's absolutely the truth. So let's take a look at a 15-year plan. So what I'm saying here is that our investor, our hypothetical scenario here, they're going to take money out of their retirement plan over 15 years, or the money that they save, they're going to take out over 15 years. So I apply the same numbers to my financial calculator, $6,000 going in, $6,000 every year thereafter, 12% ROI, 30% tax rate during our income years, and 20% during our retirement years. So in a taxable environment, again, we go to that taxable environment. Every time we're making money, we have profit, we got to pay some taxes on that profit. $70,000 a year. $70,000 a year for 15 years, all right? In other words, the money that we have to live on, giving this example, is $70,000 a year. Now, I apply the same numbers to a traditional IRA, tax-deductible account. That gives me $117,000 a year. All right, so that's my money that I'm using for in my retirement years over this 15-year plan. Now I look at the Roth environment, $146,000. So let's break down this tax savings for you. That's $29,000 in a Roth IRA. That's $29,000 in savings per year over this 15-year cycle. We look at that over the entire 15 years. That's $439,000 in taxes saved over that cumulative 15-year cycle. That's a significant number there, right? So who would like to have an extra $29,000 a year? Who would like to have an extra $439,000 over a 15-year cycle, right? Probably a lot of us on this call. But how do you do it? Well, of course, step one is having a Roth IRA. And I'm going to talk about in just a moment how you could potentially even convert traditional money into a Roth account. Now, let me stop there for a moment and mention that it's important that you look at this objectively and financially responsibly. So it would be good to, of course, team up with your CPA or your accountant or other financial professional prior to engaging in these types of accounts. You want to make sure that you qualify. You want to make sure that you're doing the right thing for your particular situation. What's right for one person is not always right for everyone else. But what I'm showing you here is some compelling reasoning for why a Roth IRA can make sense for many, many investors. All right, so we know what our savings potential is here. We know what the opportunity is. Let's move into, okay, you get the Roth IRA set up, you put your $6,000 in, or maybe you convert money over. Now, what can you invest in? How do you achieve a return on investment that is desirable for you? Maybe it's 6%, maybe it's 12%, maybe it's 24%. Maybe you're a real estate investor that buys rental properties or flips houses and consistently makes a 10, 12, 15, 20% return on investment. Equity trust isn't driving the ROI, that's you driving the ROI, being in the self-directed manager seat. So ultimately what you're going to do is you're going to determine what types of investments are a right fit for you. And with a self-directed Roth IRA, it runs the gamut in terms of what you can invest in. Here at Equity Trust, we have investors that are buying rental properties, so they have cash flow coming back in. We have clients that are flipping houses. We have clients that are making loans secured by real estate. We have clients that are investing in precious metals, digital currency known as cryptocurrency, investing in small business startups, private equity, hedge funds. In terms of alternative investing, you're really only limited by your own potential. So it's good to know that you can self-direct beyond just traditional stocks, bonds, and mutual funds. There are all of these other types of investments. And clients at Equity Trust, they leverage their own knowledge and expertise. So they find something that they're good at or they're motivated to get good at, they master it, they invest with their Roth IRA, they create tax-free profit, they leverage compounding interest in the absence of taxation, and then all of their distributions during their retirement years are totally exempt from taxation. It never hits their 1040 as ordinary income. Again, these are incredibly powerful concepts. That's why we're so passionate about it and why we're remembering William Roth today on his birthday. Now, in terms of being able to convert money from a traditional to a Roth account, all right, let's talk about that. All right, so we have a tax-deductible account, a traditional IRA, and we say, hey, I want to go ahead and get the taxes out of the way on the stock when it's much smaller so I don't have to pay it on the crop when it's maybe 20 feet high and maybe 20 feet wide, right? So this is what's called a Roth conversion. And what we're doing effectively is we're taking money from a traditional IRA and we're converting it to a Roth IRA. Now, your monies might be in a traditional IRA. They might be in a SEP IRA, Simplified Employee Pension Plan. They might be in a 401k from an old employer that's tax deductible. It might be in a 403b. You may have heard of these for teachers and people that work for nonprofits. They don't get 401ks, they have 403bs. It might be a thrift savings plan. You work for the government and you have tax deductible money in their thrift savings plan, which is the equivalent of a 401k for federal government employees. You could potentially take this money and convert it to the Roth IRA, get the taxes out of the way now. This is called a Roth conversion, all right? So let's say you have $100,000 in a traditional IRA. and you say, I want to get the tax out of the way now. You convert that $100,000 to the Roth. You're going to pay taxes on that $100,000. That $100,000 is going to get added to your ordinary income. All right, so it's going to hit your 1040 as ordinary income, and you're going to pay taxes based on your effective tax rate. So let's say you're at a 20% effective tax rate. 20% of $100,000 is $20,000. So you pay $20,000, you get the $100,000 into the Roth, and now it grows tax-free for the rest of your life, and you could potentially achieve some of the savings results that we demonstrated in this example. Okay? So we went through compounding interest, we went through the types of investments, and we went through the Roth conversion. One other item to mention on the Roth conversion. There's also a technique known as a backdoor Roth IRA, which is leveraging a Roth conversion. So what is a backdoor Roth IRA? Now, this is not a legal term. This is sort of an industry term used. So some folks, I mentioned at the beginning of the call, have been told that they make too much money. They make too much money and they can't contribute to a Roth IRA, and that is a fact. You can go to the IRS guidelines and look up modified adjusted gross income limit for Roth IRAs. To put it into perspective for you, if you are single and you make over $122,000 modified adjusted gross income, check with your CPA if you're not sure if you do or don't. If you make over $122,000 as a single individual, you can't make a full $6,000 or $7,000 contribution to a Roth IRA. If you're married filing jointly, that's $193,000. So if you make over $193,000, you can't do a full contribution to a Roth IRA, the $6,000 or $7,000, depending on whether you're under or over the age of 50. However, there are no income restrictions on a conversion from a traditional IRA to a Roth IRA. So as long as you meet the requirements to contribute to a traditional IRA, which would be you're under 70 and a half and you have earned income, United States earned income, that would be income that you're paying Medicare, Social Security tax on, and your ordinary income taxes, of course. So check with your CPA on that as well. But so as long as you have earned income, you meet all the qualifications, all you do is first contribute to this traditional IRA. Maybe you put your $6,000 in, or you put your $7,000 in, and then immediately you convert it over to a Roth IRA. This is what the industry refers to as a backdoor Roth IRA. So check with your CPA or your accountant. If you're told that, hey, you don't qualify for a Roth IRA to make a contribution, you might be able to use this backdoor Roth IRA strategy. All right, so we touched on the three characteristics, right? I want to go back to this whole self-directed IRA concept before we close up here. This self-directed IRA concept, investing in alternative assets. Now, I mentioned compounding interest. We talked about some of the advantages there. Let me give you a real-world case study. I met a client back in February on a real estate investor cruise. It was a husband and wife. And they shared with me that 10 years ago, they opened accounts with Equity Trust Company. And combined between both of their traditional IRAs that they moved over, they had about $100,000. And what they did is they immediately converted those monies into a Roth account. They paid the taxes, and they each went out with each one of their Roth IRAs. So husband and wife both had a Roth IRA open and funded now. They did their conversion from their traditional to the Roth. They each went out and bought a rental property. And those rental properties began generating cash flow. All right, so the cash flow was coming in, and they were exempt from paying taxes, of course, right? Because it's a Roth IRA. They don't have to pay any taxes for the rest of their life, so as long as they're following the rules. So what do you think they did with that cash flow? Well, they rinsed, repeated, reloaded, and reinvested. They went out and they bought another rental property, and then another, and another. And 10 years later, they now have 13 cash-flowing rental properties in their two Roth IRAs. And they are generating nearly $110,000 in tax-free cash flow. I'll say it again for our viewers. $110,000 in tax-free cash flow on an annual basis. And guess what? That will never hit their 1040 as ordinary income. If they wanted to, they could take a $110,000 distribution out every single year, and it never hits their 1040 as ordinary income. If they sell those properties, there are no capital gains tax. There are no recapture depreciation. It's all tax-free because it's sheltered in that Roth IRA. Now, take it a step further. I asked this couple, I said, okay, what's your destination? Because see, I break down this business into three phases. Phase one is you got to select the vehicles. Roth IRA, traditional IRA, HSA, CISA, a lot of different types of accounts. Phase two is you got to find investments. Could be real estate, could be stocks, bonds, mutual funds, could be small business startups, whatever it is that you're good at or you want to get good at. All right, select the investments. All right, third phase is what is the destination for that vehicle, all right, for you personally, the long-term goals. So this husband and wife, when I asked them about their phase 3, their destination, they said, well, John, we're interested in leaving this Roth IRA to our grandchildren. Because when our grandchildren get this Roth IRA, this inherited Roth IRA, it's going to be tax-free to them. And they're going to have $110,000 in net tax-free profit every single year. It'll never hit their 1040 as ordinary income. So I'm moving into another phase, another dimension of this. But it's important for our viewers to understand the power of the legacy component of this Roth IRA. So again, for our Facebook viewers out there, if you like this video, like it, share it. I also want to mention that we have a gift for everyone that viewed this Facebook Live session. It is the Roth IRA guide. We put together a guide for this training. I want you to download the guide. You'll see just below in the comment section, you can download this free Roth guide. All right. Now, there's a couple important things in here to mention. Number one, it's going to talk through some of the things that I talked about here, contribution limits, eligibility, ultimately how to get a Roth IRA set up and funded. But there's also a special bonus section in here, and it's going to talk about the solo Roth 401k. All right? There's a solo 401k designed for small business owners. So if you're a small business owner, you're self-employed, you have active earned income, you could potentially establish a solo Roth 401k, and there's some additional nuances, if you will, with this Roth Solo 401k. So check with your CPA, make sure you're qualified to do so. But if you do things right, you can have a solo Roth 401k, and when you're under the age of 50, the contribution limit isn't $6,000, it's $19,000. So you could potentially get upwards of 3 times more into a Roth environment. If you're 50 and over, the contribution limit is $25,000. Imagine that, getting an extra potentially $15,000 into a Roth environment every single year. So this guide's going to explore the Roth Solo 401k concepts with you as well. So I encourage you to check out the guide. Check us out on our website, or you can go to our YouTube channel. We have a ton of great video content and other education. Here at Equity Trust Company, as you can tell, we are incredibly passionate about education and information. We want an informed client or prospective client so that they can make good decisions going forward. We don't give tax, legal, or financial advice, but we can provide a lot of information and share a lot of valuable content. So again, to our Facebook Live viewers, I hope you got a lot out of this session, many, many more to come. Again, we're remembering William Roth Jr. on July 22nd here, Monday, July 22nd, at the Equity Trust Company corporate headquarters based out of Cleveland, Ohio. We're in a city called Westlake. Again, check us out, and if you have any more questions, you can reach out to us directly, and we can help you out on an ongoing basis. We look forward to seeing you on the next Facebook Live session.